Wall Street is preparing to pour over $500 billion into AI infrastructure, and yet the entire bet still runs through a single island roughly 100 miles from the Chinese mainland. That island is Taiwan, where TSMC makes about 90% of the world's most advanced semiconductors. Nvidia has lined up Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR to create financing platforms for AI compute, while the physical chips behind that compute remain almost entirely on that one island. This is not just a technology story, it is a story about how money, geography, and national security are now pulling in opposite directions. The pressure begins not on a factory floor, but in a financing structure. Nvidia announced strategic partnerships with Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR to establish independent compute financing platforms. Together, these platforms are expected to mobilize more than $500 billion of third-party capital over time. Jensen Huang described the goal as giving customers access to scarce compute at scale and building what Nvidia calls DSX AI factories. That is where the language changes. Nvidia now describes compute as an investable asset, one that offers the lowest token cost, highest revenue, and longest life, underpinned by CUDA and a global ecosystem of developers and off-takers. Wall Street is being invited to own AI capacity, not just by chips. But an investable asset still has to be manufactured somewhere. And that somewhere is not distributed across many countries, it is concentrated in one place. That place is a manufacturing island, not a trading desk. That one place is Taiwan, an island about 100 miles east of the Chinese mainland. TSMC makes about 90% of the world's most advanced semiconductors, and until recently those chips were made entirely on the island. This is the valve through which global AI demand must flow. TSMC holds roughly 70% of the global semiconductor foundry market and is the main chip supplier for Nvidia, Apple, Broadcom, and Qualcomm. The stakes are enormous for the island itself. Taiwan's integrated circuit exports reached $184 billion in 2022, nearly 25% of Taiwan's GDP, and TSMC constitutes about 30% of the Taiwan Stock Exchange's main index. That means AI compute is not a cloud abstraction. It is a physical export concentrated on a small island with a single dominant company. Every financing platform, every data center, every AI model eventually has to pass through a fab there. That is why this island is more than a supplier, it is the central valve in a global system. TSMC was not built to be a geopolitical choke point. It was founded in 1987 by Morris Chang as a joint venture among Taiwan's government, the Industrial Technology Research Institute, and private investors. The company became the world's first dedicated semiconductor foundry, a factory that builds chips for other companies instead of selling its own branded chips. That model made the fabless chip industry possible. Nvidia designs GPUs, and TSMC manufactures them. But this engine consumes physical resources at a scale few people see. TSMC accounts for roughly 5% of Taiwan's total energy consumption, exceeding the consumption of Taipei, the capital city. A single company's fabs use more power than a major city. So the $500 billion AI build-out is not only a financial event. It is a bid for cleanroom capacity, electricity, and water on one island. The market value may be global, but the factory floor is intensely local. And the local system is now under strain. That concentration has not slowed the boom, it has accelerated it. As of 2025, Nvidia controlled more than 80% of the market for GPUs used to train and deploy AI models. In the same year, Nvidia became the first company to surpass both $4 trillion and $5 trillion in market capitalization. The financing platforms, the DSX AI factories, and the off-takers all point the same way: AI compute is being treated like infrastructure that can be financed, leased, and underwritten. But here is the policy twist. The United States government, while trying to pull chip making onto American soil, has also imposed a 25% Section 232 tariff on certain advanced computing chips. That tariff list includes Nvidia's own H200. So the same chip that sits at the center of the AI trade is now taxed when it enters the United States. The tariff is not simply a trade measure, it is a signal that Washington sees this supply chain as too important to leave to geography alone. It is a deliberate attempt to force the physical supply chain out of its single point of failure. The White House has made the official reasoning clear: the United States' capacity to produce semiconductors and certain advanced manufacturing equipment is insufficient to meet domestic demand, leaving the country dependent on foreign sources. That is why the tariff and the manufacturing pull are happening at the same time. In March 2025, TSMC announced a further $100 billion for its United States operations, a decision President Trump attributed to tariff threats on Taiwan and the global semiconductor business. Adding that to earlier commitments, TSMC Arizona's total pledged investment reached $165 billion, making it one of the largest foreign direct investments into United States manufacturing. But the cost of moving the bottleneck is brutal. Building a TSMC fab in the United States costs 4 to 5 times as much as an identical plant in Taiwan, and chips made in the United States cost at least 50% more than chips made in Taiwan. America is paying a premium for resilience, but it has not yet replaced the island. That is the central contradiction in policy terms. So the system now runs on 2 tracks. Wall Street capital is being organized to turn compute into an investable asset, while Washington taxes the imported chips that make that asset possible. TSMC still makes about 90% of the world's most advanced semiconductors. Its Arizona fabs are real, but American construction costs are 4 to 5 times higher, and chips made their cost at least 50% more. The financial infrastructure of AI is scaling faster than the physical infrastructure can be diversified. That means the $500 billion bet is not replacing Taiwan, it is reinforcing how much the world needs it. The real backbone of Nvidia's bet is not a stock ticker or a financing platform. It is a fab on a 100-mile island, operating at the exact point where global capital meets physical silicon. That is not a weakness in the story, it is the story. The $500 billion is not a bet against Taiwan, it is a bet that passes through Taiwan. Nvidia has turned AI compute into something Wall Street can finance, but the physical chips behind that asset are still made almost entirely by one company on a 100-mile island. Washington is now taxing those chips with a Section 232 tariff and, at the same time, pulling TSMC's factories onto American soil. Yet the money is moving faster than the fabs. The next wave of capital will likely chase scarce compute wherever it can be found, but the most advanced supply still answers to a single island. The forward-looking idea is not that the island disappears from the story. It is that every new data center and every new financing platform makes that island more valuable before any alternative can truly replace it. The capital has been mobilized.